Live from London, this is Bloomberg Daybreak Europe. I'm Tom McKenzie with your top stories. Oil slides, Brent falls below $100 a barrel as US officials tout progress in talks with Iran. Secretary of State Marco Rubio says a deal could come as soon as today. The Iran deal optimism lifts global stocks, Japan's Nikkei hitting a record, while futures point to gains here in Europe. And ECB President Christine Lagarde says the central bank is likely to raise its inflation outlook next month, paving the way for a potential rate hike as strategists warn that markets face higher for longer yields. Let's check in on the markets then around the optimism that is focused, of course, on that potential Iran-US deal. Different commentary coming out from both sides over the weekend. And as we mentioned in the headlines, Marco Rubio suggesting that we could get more details potentially as soon as today. We continue to watch that, of course. So you're seeing record highs over in Asia for the Nikkei. Across the benchmark, you're seeing gains of 1.4%. Global stocks closing in on fresh record highs then on the geopolitics. European stocks pointing to gains of around 1%. Of course, the UK is closed. UK markets are closed for a bank holiday. S&P futures pointing to gains of 0.9%. It is Memorial Day in the US as well, so treasuries are not trading. Let's flip the board and have a look cross asset. The focus, of course, on what's happening in oil, with Brent right now at $97.80, with oil prices down more than 5% then on the developments out of the Middle East. The dollar is under pressure as well, falling 0.3%. You can tie that to the risk reversal that we're seeing across assets then on the back of geopolitics. And yields are lower when it looks at JGBs. So there's a bid for JGBs. Yields down 6 basis points on the benchmark Japanese 10-year right now, which is currently at 270. Let's get you up to speed on the risk events this week then. Tuesday, we get US-made consumer confidence data. That will be in focus as we continue to try to get more colour and more detail on the health of the US consumer. On Thursday, US April PCE, so that preferred measure of inflation for the Federal Reserve, that will be consequential. And on Friday, we get May flash inflation data out of Europe. Even if we get a deal, of course, to reopen the Strait of Hormuz, the longer-lasting effects of that closure of almost 3 months will continue to be in focus for investors. So detail there and the inflation story out of Europe towards the end of this week. The opening trade starts, of course, Daybreak Europe. So senior US officials say the US and Iran are closing in on a deal that would reopen the Strait of Hormuz, even as President Donald Trump insisted he would not rush into an agreement. Speaking in India, US Secretary of State Marco Rubio said a deal may be reached today.
We're still a work in progress. As I said, we thought we might have some news last night. Maybe today. I wouldn't read too much into it. It takes a little while to hear back. So we have what I think is a pretty solid thing on the table.
Joining us now is Stuart Livingston-Wallace, our executive editor for the Middle East, North Africa and Russia. Stuart, we seem to be making progress then towards at least a prelim deal. There's a memorandum of understanding. That is some of the reporting. What is likely to be in this deal at this stage? How much movement do you think has actually been made between the two sides?
Yeah, good morning, Tom. I mean, it's clear there's been some movement, and at least in part we know that because all sides are saying so, which is unusual. Typically the White House is very bullish or very bearish, and the Iranians kind of give a reality check to that. But what we have now, as you say, it appears to be the outlines of a memorandum of understanding. So there's a lot of caveats here that is pretty preliminary. Most of it seems to be focused on getting Hormuz reopened. And candidly, that is in effect trying to unpick the major consequence of starting this war in the first place. And then the broader issues of the nuclear file and everything else will come at a later stage. But the critical thing here is that all sides say we're moving towards something. What is interesting, though, is over the weekend we had quite a whiplash in terms of the tone of the rhetoric. Saturday, everyone was very bullish, at least on the American side. By Sunday, that had come off somewhat, moderated, because the Iranians came out and said there were a couple of sticking points remaining. So again, we may see something in the next day or two. The timeline here is really hard to pin down, but we are making progress, it seems.
In terms of that conversation and what we've been hearing from the two sides then, how should we interpret the Iranian positioning on this? The rhetoric, at least the communication from the Iranian side, seems to be more cautious. Do we have clarity in terms of how unified the leadership is there and what to make of the communication out of Iran?
No, I think that's a very good point. I mean, in terms of what we've actually heard, it's really been from the official and semi-official news agencies. You know, they don't have their leadership tweeting every 5 seconds. So it is much harder to tell what's going on. And as you say, quite what the hierarchy is there and who's making the decisions on a day-to-day basis is quite hard to parse out as well. I think from the Iranian side, they feel like they have a lot of leverage here. They clearly do have a lot of leverage, perhaps unexpected leverage in terms of the closure of Hormuz. And it seems that they're very reluctant to cede on some key points without some major concessions on the other side. So I think what they're particularly focused on is the unfreezing of some of their assets, perhaps all of their assets, some unwinding of some of the sanctions. In other words, all the things that have really hobbled their economy over the last several years, and would basically give them the strength to sort of keep that regime going in the face of what is a very, very difficult economic situation for them. Remember, they're one of the biggest energy producers in the world, and yet they have rolling blackouts in terms of the electricity supply. You know, this is not a good position for them to be in. So I think fundamentally that's probably what they're after here, is major concessions.
Okay, that's really interesting. So the pressure on the Iranian domestic economy and the concessions that it will continue to push for. The market reaction then, of course, we've seen lower oil prices, equity markets are up. It seems the reaction seems potentially less acute than we've seen in previous rounds where we've seen some progress. What is your assessment of how markets are reading this and whether or not many investors are kind of looking through this already?
Yeah, I think that's a very fair assessment. I mean, it's not just the oil market. You look at European gas futures, they're off by a similar sort of magnitude this morning. You know, the dollar's a little bit weaker. You look at the move in equity markets, it's a little bit stronger. I mean, one market you could look at, and, we're always cautious about this because there's only one data point, it's not a massive market, but look at the prediction markets, and I think that tells you a lot about the kind of that changing mood over the weekend. So in terms of the odds of there being a comprehensive peace deal between Iran and the US by the end of June, that started the weekend right around the sort of the 30% mark. It shot up to about 81% on Saturday, and now it's back down to maybe the high 40s. And I think that sort of roller coaster ride is a pretty good reflection of how that mood shifted over the weekend. So I think as of Monday, things are definitely more optimistic than they were on Friday. But again, there's that caution because we've been in similar situations before, and the whole thing can collapse rather rapidly. So more optimism, but I think it's a guarded optimism.
Stuart, thank you very much indeed. The context, of course, in terms of what we've been hearing from both sides and the potential consequences. Stuart Livingston-Wallace, our executive editor for the Middle East, North Africa and Russia. Thank you. So falling oil prices sending stocks higher this morning, as we've been discussing. Japan's Nikkei at a fresh record high in Asia. Futures gaining as well. Let's bring in Ven Ram, cross-asset strategist at Bloomberg MLive. We should note as well, JGBs are bid with yields down, at least so far in the morning. Treasuries, of course, not trading today, so we'll watch for that signal when US markets reopen. Then, positive signs then from the US side. What is your take in terms of how the market has reacted so far to the developments around this potential deal?
Morning, Tom. I think it's kind of measured optimism, as kind of Stuart was alluding to. I think that, if you look at equities, obviously they're rallying a bit on enthusiasm that this deal can go through. But I think that this raises the longer term questions, right? I mean, in the first place, we don't know whether the deal will come through or not. I mean, there have been so many changes and last minute twists and turns to this narrative in the past 1 month. So I wouldn't discount the deal faltering at the last minute. It's not a given. But if the real deal goes through, I think that what we are going to see is a bit of a relief rally in equities, if you can call that a relief rally, because they haven't really meaningfully fallen in the past few sessions. But I think that, tech stocks definitely have the momentum to continue upward from here, because if you look at the Nasdaq 100, Tom, the fair value is about 29,900, and we are pushing through to inexorably towards those levels. But what worries me is the level of froth in the S&P 500. I think that the fair value of S&P 500 is 5,700. We are almost 2,000 points above that. So there is plenty of froth in the non-tech space. And I think that that is what worries me at night. How is this going to play out? And what does it mean for longer term investors? If you're going to be in the market for the next 5 years, for the next 10 years, what are the kind of prospective returns that you can expect from a market that is nearly fully priced with a lot of froth and with an equity risk premium of nearly zero?
Okay, interesting. What keeps you up at night, Venram, with froth in the S&P 500? To the here and now, we've been talking, of course, in the last few weeks about the rout in the global bond markets. Some of that is being readjusted today as we look at JGBs. If we get a reopening of the Straits of Hormuz, is that enough to drive further momentum to the upside in terms of bonds with yields down, price up? Or does the concern about government spending and global deficits offset any potential rally for bonds?
No, I do think that there are opportunistic plays in duration. I think particularly the 30-year end. I'm not so bullish on the 10-year treasuries, but if you look at the 30-year DOM, I think that we approached 520 last week, and we have quickly rebound from those levels. And I think that if this deal goes through, I think there is going to be a short-term rally in long duration bonds. There's no question about it, because 5% has proved to be the line in the sand. We have breached that line, and we have gone up well above that. So I think that there will be a relief rally. Look, deficits are not going to go away. They are a threat, and we are probably in a situation where inflation is going to be sticky for a long time. But even so, I think that you want to be scaling into the duration here. And I think there is opportunity, because all the bad news that is in terms of bonds is kind of already reflected in the price. And at 515, 520, I would be a buyer of 30-year treasuries. It's a very completely different story at the front end of the curve. I think that the markets are underpricing what the Fed has got to do here. Even with the Hormuz, assuming that the Strait reopens, I think, as I was mentioning, it's going to be higher for longer on inflation. And I think that the front end is mispricing. I don't think there is room for the Fed to be cutting rates. And in fact, you would expect the Fed to raise rates, presumably by the end of the year, which is not priced in really by the market. So I think that essentially we are going to be positioned for a flattener year, with the front end selling off a bit and the long end coming down a bit.
Okay, interesting. So opportunities at the long end with the 30-year in focus, but you maybe look to avoid the front end on expectations that the Fed will have to hike. Interesting to hear, of course, from Kevin Hassett saying that once oil prices are lower, he does believe that the Fed will have space to cut. Venram, cross-asset strategist at Bloomberg MLive. Always appreciate your insights, Ven. Thank you. Still ahead, warnings of a global crisis in food prices. That's unless action is taken to ease fertilizer shortages caused by the war in Iran. We discuss with the chief economist from the Food and Agricultural Organization, the FAO. But first, US Secretary of State Marco Rubio hailing ties with India as the country seeks to shore up fuel supplies. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the dramatic turnaround at Rolls-Royce under Tufan Erginbilgic is one of the great corporate overhauls in recent times. He made headlines for describing the flagship engineer as a, quote, burning platform when he took the reins in 2023. Shares are now up more than 1,000%. On the latest episode of Leaders with Lacroix, Francine asked him if he feels like he's carrying the weight of British industry when so many companies have spoken about exploring a listing in the US.
Yes, sometimes, because I think there's this discussions whether companies should move to the US market. I'm sure, Francine, you asked those questions. So actually demonstrating that you can be in this market. And frankly, after a point, it is never about you. You don't want to fail all the stakeholders, employees, investors, even government. Once you pass a stage, right? Okay, you have a success. Now make sure that is sustainable success and actually you can build on it.
What can other British companies learn from Rolls-Royce?
I mean, a lot. But business model level, are they actually set up to win? If not, fix the business model. And you do that, then of course you need to energize your employees. It's not about you. It is about 50,000 people. I am non-compromising for that. You may say blunt or whatever, but non-compromising. Mediocrity at that level kills the organizations, but also good people, then you need to develop them and have a great career in this.
How do you manage good people? What do they want?
Effectively, you want people in your organization who are highly marketable, but they want to stay with you, right?
Right.
So that's what you want.
That's a secret sauce.
Exactly.
Right.
That's what you want, right? That is almost 360 performance management in my mind. And 360 performance management always, if you want to close the circle, it finishes with reward and recognition. And then grow the company, because that creates all sorts of career opportunities. Shrinking companies, you have less opportunities. Grow the company, that actually feeds itself.
Right. I mean, every time I see you, we speak about small nuclear reactors.
Yes.
Because you it's not a 360 view. It's a very granular, it's almost problem solving. It's engineering.
I always go to big picture before I come to small picture. Europe cannot do without it. World needs it for net zero. Frankly, Europe needs it for supply security, full stop. Because even before geopolitics, Europe needed that. After some geopolitical events, frankly, Europe needs it more than that. So therefore, SMRs make sense at big picture because they are less risky, because smaller plants and manufacturing activity. Nuclear industry has a bad sort of experience with projects. They take longer, much more expensive. SMR, 85% manufacturing process. You learn. You learn, and it is modular, it is standard, rather than every nuclear project bespoke EPC project in a way, right?
Anything could happen in the world of politics, as we've seen.
Yes.
Right. How do you deal with politics, with events outside your events? And even here, you could see a change in government with reform coming into power.
Yeah. I have a principle in business. I always tell people, once you get into trouble, it is too late. So you need to prepare the company before you get into trouble. So what does that mean? Like, we are actually living with it as we speak, and last year we lived with tariff. But first of all, make the company very resilient. That was our drive. We did that. So external shocks, we actually deal with it a lot better. Mindset is more important than anything else. You need to have the mindset and the response capability in the company. You need to develop that before you are in trouble, because it takes some time, right? And then you need to be agile using that capability. And then last thing you are going to do, you are going to be action-oriented, not explanation-oriented.
But if you don't know what the trouble is, are you scenario planning for all the things that could change?
It's not about actually predicting the world. It is about how your company now thinks about dealing with external shocks, right? So that is the capability, the processes, the mindset. Like, we are now responding to current shocks. I can assure you, we couldn't do half of what we are doing 3 years ago. Probably 10%. Probably when I said something, people would look at me with blank eyes. What is he talking about? Today, I don't need to say a lot. I need to give the context, and people are in action.
And the full interview has a global release on Bloomberg TV later today at 10 p.m. UK time. Let's change chat right now and focus in on what's happening in terms of Marco Rubio's visit to India. India says it sees the US as a significant and reliable energy partner as it seeks to shore up fuel supplies. India's foreign minister met his US counterpart, Marco Rubio, of course, who hailed their country's ties as one of the most important globally.
We also are strategically aligned on energy. You know, energy is, and the ability to generate power is the key behind all of the great industries out there. Whether it's data centers, whether it's artificial intelligence, whether it's the ability to modernize and continue to advance economically, all of it begins and ends with the ability to generate the power necessary, not just to raise standards of living, but beyond that, to expand into new industries. And both of our countries are strategically aligned in ensuring that we have a world that can not just produce but deliver the energy resources that are necessary to power a modern economy.
We strongly believe that energy markets should be left, to the market.
While Rubio is on a 4-day visit to India aimed at improving bilateral ties, let's get more now from New Delhi with government reporter Sudhi Ranjan Sen. Sudhi, thank you for your time on the back of this visit. What are the main takeaways so far for you and the team?
Well, to begin with, the main takeaway, I would say, is, both sides trying to arrest a drift in the relationship that had, set in, especially since last year and with tariffs being imposed and India being penalized for buying Russian crude. There was a drift that had come in the relationship. And this visit is in a way trying to arrest that drift, trying to reassess and build from here on between the two sides. So that is the main takeaway. The others, of course, the associated ones are what we see both Minister Jaishankar and Secretary Rubio saying, and very clearly India is looking now at the United States more closely for energy. There was discussion on nuclear energy, as the minister informed us during the press conference. So both sides kind of trying to come closer, find out more areas of cooperation rather than friction. That's the big takeaway from the ground.
OK, Bloomberg government reporter Sudhi Ranjan Sen in New Delhi with that update. Sudhi, thank you very much indeed on that 4-day visit, of course, by the US Secretary of State to India and potential closening of energy ties between the two nations. Coming up, more changes to the US green card system, meanwhile, with potentially far-reaching ramifications for legal immigration. We have the details. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's get you up to speed on some other major stories this morning that we are following. The cause of an explosion at a mine in China's Shanxi province is under investigation. At least 82 people were killed in the blast on Friday. The accident has triggered a vast rescue operation involving hundreds of emergency workers and an intervention from President Xi Jinping and senior officials. State media say early investigations suggest serious violations at the privately run mine. There is plenty more coming up. Stay with us. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. Good morning. I'm Tom McKenzie with your top stories. Oil slides. Brent falls below $100 a barrel as US officials tout progress in talks with Iran. Secretary of State Marco Rubio saying a deal could come as soon as today. The Iran deal optimism lifts global stocks. Japan's Nikkei hitting a record while futures point to gains here in Europe. And ECB President Christine Lagarde says the central bank is likely to raise its inflation outlook next month, paving the way for a potential rate hike as strategists warn that markets face higher for longer yields. Let's check in on the markets then. Of course, the oil price movements on the back of geopolitics front and centre. That is lifting the mood around equities. The dollar is down. Across the Asian space then, you are close to record highs across the benchmark MSCI Asia Pacific with gains of 1.4%. You're seeing upside in terms of the European futures picture as well. The UK, of course, closed for the bank holiday, but across the benchmark, European futures pointing to gains of more than 1% after a positive week for European equities last week, ending up through the week in positive territory. S&P futures then stateside looking to add 71 points, pointing high by 0.9%. Let's flip the board then and look cross asset. Oil prices then lower on the back of the developments in terms of this potential deal between Iran and the US. Currently down 5.6% on Brent, $97 a barrel. The dollar under pressure, so that's a benefit in lifting some of the Asian currencies and EM as well. Currently down 0.3% on the Bloomberg dollar index. Japanese yields are lower across the curve then. Money moving in to sovereign debt, yields down. And we'll see how that plays out, of course, when US Treasuries start trading after, of course, Memorial Day and that holiday today stateside, of course. Time now for your front page news. The FT leading on the Iran war with the line that Donald Trump has told US negotiators, quote, not to rush into a deal, saying both sides must take their time and get it right. Meanwhile, the Wall Street Journal also leading with the latest from the Middle East, of course, and the US president saying there is no rush for a deal. So both the FT and the Wall Street Journal with that caution from the US president. You can get a roundup, by the way, of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DayBGo or DAYB Go on the terminal. Let's get back to the market reaction then to the geopolitics, to the developments in terms of the conversations between Iran and the US. Because global stocks are climbing towards record highs this morning, as I mentioned, on that optimism on a US-Iran deal and potentially, and crucially, of course, a potential reopening of the Straits of Hormuz. So oil prices lower on those developments. Let's get more now in terms of the market reaction with Charu Chanana, Chief Investment Strategist at Saxo. Charu, good morning. Thank you for joining us. What do you make of the market reaction to this news? The markets does it just underscore that investors are already looking through Iran to the next catalyst? What do you make so far the market reaction to the developments out of the Middle East?
Good morning, Tom. Thank you for having me back. Certainly a bit of an exuberant reaction this morning in Asian hours. And I think a part of it, of course, comes from the optimism that we are seeing, hopes of a deal being talked up as of now. But also, I would say the thin liquidity in the markets today. We had Korea closed, we had Hong Kong closed, going into your European hours. We have London closed, we have US on a holiday as well today. So it is going to be a very, a less liquid day, so to say, and that obviously amplifies the moves a little bit as well. So it's hard to read into that reaction. But having said that, the first order effects of that potential deal are very clear. We see oil going down, at least to an extent where we start to take out that geopolitical risk premium. Of course, there are still a lot of sticking points, especially on that reopening of the Strait of Hormuz as to how long it takes, the demining operations, how long it takes for insurance costs really to come down. And those are things that keep oil still lingering. I mean, we're still above $90, so still higher than the pre-war days. And I think that's where we stay sticky for some time for now, as long as that longer term outlook on the Strait of Hormuz gets clearer. But when it comes to equities, equity markets have not really priced in that disruption to a large extent. Looking at how equities have done despite this conflict being going on, it does seem like that the risk of the downside, if the talks break here, are certainly higher than what optimism can be priced in at this point.
Yeah, that's really interesting. Charu, even if we get a resolution, even if we get a reopening of the Straits of Hormuz within weeks or a number of months, is there still the risk for equities that the inflation and the price push and those second order effects becomes a headwind for global equities?
I think, Tom, the most important metric to watch here is not really, at least in terms of the inflation and the oil price outlook, is not just the deal itself. it certainly brings the focus a lot more towards the reopening of the Strait of Hormuz. And I think one of the more positive developments that we've seen over the weekend has been that, there have been 33 tankers that have passed through. So I think if we keep getting headlines like that, it does give a bigger weight to the, option of reducing that insurance cost, the geopolitical, the war premium that has been priced into those shipping numbers, shipping costs. And I think that really lends a greater optimism to stocks at this point than the deal signing itself. I think the follow through remains far more important. But having said that, I think you're really right to point out that inflation risks particularly do not end with that news about the Strait of Hormuz reopening, even if it's one shot, not in phases. As we're not very clear as to how that is going to play out right now. So that inflation shock is something that the equities have not fully responded to as of now, and rightly so, because the earnings momentum has been very, very strong. I mean, the S&P 500 has delivered 30% plus kind of earnings in the first quarter. So as long as that continues, I do think the earnings momentum will start to get more scrutiny if inflation numbers start to shift higher. And the thing here is that central banks can sound hawkish to save their credibility going into that kind of an inflation shock. But since it's been a supply-driven shock, they cannot really hike rates to address that shock. So that will be a very difficult situation for equities to really come face to face with, and certainly a risk that investors have not given enough notice to as of now.
So just to push on that point, Charu, you think that the market pricing for one full hike from the Fed this year, that is a market, those are traders getting ahead of their skis, that the Fed actually is constrained in terms of its ability to hike rates? Is that the point you're making? As Kevin Hassett, for example, the chief economic advisor, of course, in terms of the White House and that view from the Trump administration, suggesting that once oil prices are lower, once the Hormuz is reopened, then in fact the Fed can cut. But maybe we put that one to one side at the moment. Traders betting that there will be a hike from the Fed this year. You're saying that is unlikely.
It seems to be so because, hiking rates into a supply-driven shock just exacerbates the problem, right? I mean, if we were to get a stagflationary outcome out of this, then that is worse than what we are currently facing, where at least demand is still holding up. But of course, central banks have to sound hawkish and traders have to price it in, because a demand shock is the only way to kill that persistent inflationary shock, right? So I think, traders will stay on the edge a little bit, but for central banks and specifically the Fed, where the demand outlook has not weakened materially. Of course, if you look at some of the other parts, maybe in Southeast Asia, for example, the demand outlook has changed drastically since the conflict began, not so much in the US. So for the Fed to be able to respond with a rate hike to this supply-driven inflation shock, until, of course, it gets materially worse from here, that seems to be a bit of a stretch to me.
What is the next catalyst, do you think, Charu, for the AI trade? Because, of course, the markets have been caught between these two competing pressures, really. One is the AI momentum and the other is the energy shock. And it seems that they've led into to the AI upside. What for you is the next catalyst when it comes to the AI trade?
Tom, there's only one catalyst to the AI trade, and that's really about looking for the bottlenecks. That has obviously shifted. The story has really shifted on that front as well over the course of the months. But from what we heard from, say, NVIDIA's earnings, which has been the benchmark of this whole AI trade for the longest time, last week with its earnings, we saw a clear trend that the market is now moving in terms of its AI trade from generative AI to agentic AI and over time to robotics as well. So certainly, I think that shift, and then what kind of bottlenecks that brings. Energy, as you mentioned, certainly stays a persistent theme across these. But now AI has moved from being a GPU story to being a full stack story, and how that increases the demand for, say, servers, for networks, for bigger memories. I think where those bottlenecks are and still priced attractively enough that and assuming that they're going to continue to deliver earnings the way NVIDIA has done over the past so many years now, I think that's the only key driving theme for the AI story now.
Okay, really interesting. Charu Chanana, always smart on these markets, Chief Investment Strategist at Saxo. Charu, thank you for that analysis. Coming up, warnings of a global crisis in food prices, meanwhile. That is, unless action is taken to ease fertiliser shortages caused by the war in Iran. More on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the European Union has suspended customs tariffs on some fertilisers for a year as the war in Iran chokes off supplies. The effective closure of the Strait of Hormuz has restricted shipments of urea, which is a key component in nitrogen fertilisers. The UN has warned of a global crisis in food prices unless action is taken soon. Joining us now is Máximo Torero, Chief Economist at the Food and Agricultural Organization of the UN, the FAO. Máximo, good morning. Thank you for your time. How acute is the challenge right now as you see it?
Good morning. The challenge is getting tighter and tighter. We are in day number 86 since the closure. Our red line was day 90 because it will touch all crop calendars of the world. So what we have right now is increasing oil prices. Today is 92, 95, so more or less 55% more compared to the pre-conflict. Natural gas between 60 to 85%, which is used for producing nitrogen, and urea prices 25 to 55% increase depending on the region. At the same time, the freight cost has increased 43% and the bunker fuel cost 58%. So all these are inputs necessary for agri-food system, for agriculture and from planting. And that's why this will move forward in the following months in increasing prices. We are also looking at the commodity prices, and the commodity prices are starting to increase. Corn 9%, soybeans 25%, wheat 8%, rice between 2 to 9%, depending on the type of rice.
How close are we at this point then to a crisis? How long does this have to continue to get into crisis territory? Are we days and weeks away from this potentially, Máximo?
No, I think now we are looking at the intensity of the impact. No, once we reach 90 days, we are touching all the crop calendars of the world. That means that planting decisions are already made for the next half of the year, and for 2027, it will be made later in the year. Now, if the strait opens tomorrow, what we'll have is potentially a lower intensity and a lower probability of a significant crisis. But what we will observe, no matter it opens tomorrow, is an increase in commodity prices, potentially food price inflation. And as it was said before, governments will have to react to this through interest rates. And that's the challenge, because that will also affect economic growth. So I think now the question is how intense this will be and how much this could also be exacerbated with the potential El Niño.
What is you've gone through a number of the different input costs that go into food, from energy to fertilizer. What is the potential for the world to respond in terms of alternating supply chains to mitigate some of the impact and diversifying to try and soften the blow of the restrictions that we're seeing as a result of the closure in the Strait of Hormuz? How adaptive is the system right now, and what would you prescribe in terms of potential changes to try and mitigate some of these impacts?
Yeah, sure. Right now, in the short term, the improvements of the availability of these type of inputs is very marginal, because these type of inputs require significant investments that take years. This is very different to the war in Ukraine, where we were talking of a gap in wheat, where countries that export wheat could create a supply response. Here, it's more difficult. But marginally, there can be some improvement from other routes, for more supplies from the US, from Venezuela with less sanctions, from Guyana and other countries, but very marginal. So that option, I think, is a marginal improvement, and countries are trying to do that. The most important thing here is to avoid export restrictions of energy and fertilizers. That's what will help the system not to exacerbate even more. And also to try to secure the viability of the farmers through some financing mechanisms, like what we did in COVID-19, like loans which are for 24, 36 months with a grace of periods of 6 months, that will allow them to survive until we pass this threshold, and to help countries which require balance of payments gaps to be covered, and which are in debt straits. Case of Bangladesh, for example, and now the case of India, and the case of other countries who really are seeing tight balance of payments problems, and they need to pay a bigger import bill because this increase in inputs. Now, in the long term, we can do a lot. We can diversify supplies so that we have strategic reserves in different regions to be able to cope for a period of months for a similar, because today is the Strait of Hormuz, tomorrow could be the Panama Canal. Second, we have to diversify the energy mix of the agri-food systems. The world has improved in the energy mix, but not yet transmitted to the agri-food system. And we have seen this because of the pumping of irrigation. Most of them are using diesel. And that's a big problem right now because diesel is increasing its price. And also we need to create innovation funds to find alternatives like green ammonia, biofertilizers, which could be improved in 2 or 3 years. Right now, they are not cost effective. So a lot of areas where significant investments can be done to diversify this sector for the future.
Are you seeing evidence of that diversification? So it sounds like you are seeing evidence of that diversification already. And maybe one of the silver linings of this crisis is that it does catalyze more of that diversification. How much of a spread is that happening across the world? Are wealthier nations better placed to be able to invest around more resilient food supply chains? Does it create further gaps in terms of the haves and have-nots in terms of food supply and resilient food supply?
Of course, wealthy nations are able to produce and put in place in the short term more fiscal measures, but there's dangers. As you have seen in Europe, there were several fiscal measures, and now the IMF already alerted them of the potential risks of that, and also other regions of the world. But the countries which are with debt stress and with less fiscal capacity, these type of measures will be extremely risky. And that's the danger of this. So we need to be very careful on the policies, even coming from wealthy nations, because at the end of the line, this is a supply shock. This is not a demand shock. So if you put subsidies and you put price controls and so on and so forth, the only thing you are creating is increasing the demand, not in a real way, and that will create more pressure for the whole world of the prices of these commodities. So we need to be very careful to keep the balance. If not, the world could be impacted also by what wealthier nations will be doing.
Máximo, thank you very much indeed. Important insights in terms of the pressures right now on the global food supply chains and potentially some policy measures as well that could be thought about at a government level. Máximo Torero, Chief Economist at the UN Food and Agriculture Organization. Now to some other corporate news this morning. Delivery Hero gaining on Tradegate after Uber offered to buy the company in a deal that would value the German firm at more than $11 billion. This comes as the US tech giant works to ramp up global competition with DoorDash. Uber, which owns 20% of Delivery Hero, has offered approximately $38 per share. That would put Uber on the hook for around $9.3 billion under those terms. The ride-hailing giant also has options for another 5.6% of shares. NVIDIA CEO Jensen Huang is urging Supermicro to tighten compliance. That's after Taiwan detained 3 people over allegedly fraudulent declarations linked to AI servers. Supermicro says it's working with industry partners to safeguard advanced US tech and intellectual property and will strengthen its compliance program. Huang spoke after arriving in Taipei on Saturday.
We're rigorous in explaining to all of our partners all of the world's laws and regulations, and we insist that they're compliant with laws and regulations. Ultimately, Supermicro has to run their own company, just as everybody has to run their own company. And I hope that they will enhance and improve their regulation compliance and avoid that from happening in the future.
OK, there's plenty more coming up. Stay with us. This is Bloomberg.
If you roll back the clock, 8 weeks ago, I think the view was the next Fed move would be a cut. It's just a question of how late in the year was it going to be. Because of oil prices being elevated and inflation readings being stickier, now the view is, and probably the conditions would warrant, the next Fed move may actually be a raise.
Goldman Sachs Vice Chairman Rob Kaplan of the potential of a Fed hike, formerly, of course, a Fed governor himself. Also hearing as well over the weekend from Kevin Hassett, of course, the advisor on economic affairs to President Trump, that he thinks that once oil prices come down, there will be scope for the Fed to continue to cut rates. But that is out of consensus with what the markets and traders are now pricing in. So certainly what you're seeing from this chart in terms of the implied probability of a Fed hike, the expectation is that the Fed will hike once this year. Traders are now fully priced in 25 basis points, 26 basis points in terms of the move higher in rates out of the US. On expectations, the Fed will be pushed into that higher rate environment as a result of the inflation push, of course, that's coming through. And you can tie that back to what is happening around Iran and Strait of Hormuz. We continue to monitor, of course, developments on that front. But there is the disconnect then in terms of what you're hearing from the Trump administration and what traders are expecting from this new Fed under Kevin Warsh, of course. And in terms of the inflation story, some more detail in terms of how AI is feeding into producer prices. Really fascinating chart that breaks out how AI is becoming a bigger component now of producer prices. You can see that contribution in the white line from semiconductors then, and how that has moved particularly and significantly higher in recent months. Not quite at the same level in terms of what's happening in terms of the metals and electronics, but there has been a sharp tick higher in terms of the AI contribution to producer prices. So think about that as well in terms of a trend that will continue into the future, you would expect. Let's flip the board and have a look at terms of what's happening on the consumer side. You have the University of Michigan Sentiment Survey, the consumer that came out at the end of last week, and the consumer in the US still feeling pretty negative. That is the yellow line, so dipping to 44.8. So the consumer in the US feeling very cautious and very concerned, and yet consumer stocks, there is that crocodile mouth-shaped gap between the US stock performance linked to the consumer and consumer sentiment. So at what point will that close? And to what point is that a disconnect that may put some investors in those stocks feeling a little bit uncomfortable? So far, those stocks, the consumer stocks, have defied the pessimism amongst US consumers. Now, to access, search and save all of the Bloomberg Terminal charts that are used on this show and across Bloomberg TV, Terminal subscribers can use the function Chart TV Go. Think about the risk events this week then. Tuesday, we get US May consumer confidence. On Thursday, we get US April PCE, of course, that favoured gauge of the Fed. And on Friday, we get May flash inflation across Europe as the ECB signals it may be preparing for that rate hike, of course. The opening trade is up next. Stay with us. This is Bloomberg.